technology research, kind of a Magnum PI shirt on. The jacket's muted. You went with the shirt today for this appearance. All right,
okay.
we can do that. Dan, since it's the beginning, we're at the very end of the year, so we always want to, think that suddenly the calendar has anything to do with it. But we are interested in 2026. So you've got some tech stocks that you like, and then it's notable that some are missing from the ones that you like. So I'm just wondering, does that mean that you're negative on the ones that don't make the list, or that you just like the ones that make the list better and they're all going to go up?
Yeah, it's a great question. I mean, look, NVIDIA, that continues to be one of our top names overall going into 2026. But I mean, the reason the 5 that we picked, Tesla, Microsoft, Palantir, you look at CrowdStrike and, and even Apple, it's about the derivatives of the AI revolution playing out. I mean, that's our whole thesis going 2026. For every dollar spent on an NVIDIA chip, there's an $8 to $10 multiplier across the rest of the tech. And that's why I think those are the names. Those 5 are the ones specifically going into early part of 26 that I think are going to boom. I mean, that's why we pound the table on those 5 names.
Exactly. So that you kind of summed it up right at the beginning. You said, look, NVIDIA is one of your favorite names, but it's not one of the 5 that you mentioned. That doesn't mean that NVIDIA is not going to do well. You said them quickly. So Microsoft, what's the story on Microsoft? Azure?
I mean, look, when you look at enterprise, as you see the movements in the cloud and AI, Redmond, they're really owning that race. I think this is a stock $100 upside. That's why Microsoft sticks out on Azure and AI demand front and center.
Great. Apple, you mentioned quickly, but Apple it doesn't even matter if they're any good at some of these new things. They're just so good at what they do with everything else.
Yeah, and Joe, I think the whole thing for Apple is like, look, they've been on a treadmill 2.5 speed, right? They've been nowhere in AI. But now as we go into 26, we expect a major Google partnership in terms of the spring. Now the consumer AI revolution goes through Cupertino. And I think that is significant. We talk about $75 incremental of the stock as the AI multiple. That starts to increase for Apple. That's why I view that as just a glaring name that sticks out.
If I text someone and it's green, it's like, what's wrong with you? I don't know how other people compete with Apple. The ecosystem is so powerful. At least I'm a simpleton with this kind of stuff, and I just can't imagine trying. You got anyone not have an Apple and not have an iPhone?
Too.
No one. Who has? If you have an iPhone, is it always blue with your text? I'm like a neophyte. Is that the way it works?
I thought there was some.
There's some
to that,
messages that could be. But if someone, sound like an idiot, but if someone does have green, is that not an Apple when you're texting them? Is that really?
Well, no, but usually that's why we usually delete them from our text chain, right? I mean, when someone's a green, so that's always a red flag.
Right. I know. It's just I do so many things, and believe me, I'm a novice at all this stuff. But Apple's just got a lock. How about Tesla? Why is that trading it? What's a multiple now? It's about robots?
Well, look, I think the whole story is the autonomous chapters now coming to Tesla. And I think this is going to be the most important year in its history for Musk and Tesla because of autonomous and robotics. And I think we think autonomous is worth $1 trillion alone to the Tesla story. Now Musk, wartime CEO. And it speaks to our view, look, for the first time in 30 years, the U.S. is ahead of China when it comes to tech. And I think Tesla front and center in terms of physical AI. That's why we love that name.
Period right now.
It's early. It's something my father invented back in '72. It's in the '73 almanac. Believer in it as an indicator, yes. And the fact that the last 5 days of the year, the first 2 of the new year, are a bullish period. It's when, not everyone's around. People are buying up stocks, making new lows and bargain stocks and stuff that was sold for tax loss selling. So I'm a believer, but it's really an indicator. It's not just a rally to trade. It's something we need to look at. And if Santa Claus fails to call, bears may come to Broad Mall, as my father said and coined that phrase back in 72.
You're a poet. You didn't even know it.
No, it's him. No, it's a poet. But it's only a may come. It's something, it's a flag. You start to look at other indicators combined with our January barometer, which also was invented by Yale back in 72. And the first 5 days of the year gives us our January indicator trifecta. All 3 hit the first 5 days of the trading days of the year, the Santa Claus rally that you mentioned, which you got right, And the full month January barometer for the S&P is up 90.6% of the time, 29 to 32 years, for an average gain of 17.7%. So hitting the trifecta, pretty good for the market.
All right, so that's something to watch for. So we got to see if we get that Santa Claus rally first to get that trifecta.
A few days left.
All right, I want to talk to you about the full year of 2026. Sure. A lot of talk about the fact that there's no strategist out there who are bearish about next year. Everybody's bullish about it. A lot of talk about that. I want to hit you with something else. Sure. We had a guest yesterday that gave us a great stat. Second year of a presidential term, obviously. Yep. Next year is President Trump's second year. The average gain on the S&P is 3.3%. But you're looking at a different trend. The sixth year of a president's term, even though obviously President Trump's terms are broken up between President Biden's presidency and in between, you're still looking at that trend of the 6 year. Now, what happens on a 6 year when it comes to the markets?
Well, the president's really trying to cement their legacy. It's kind of like a pre-election year of a regular term where they're really trying to push as much through as possible to make the people happy, to cement their legacy, to keep their party in power. And, we've seen a president that's pretty hands-on and interested in his legacy and how he's perceived. And I see that happening here. All of the worst-case scenario, fallout from the policies and tariffs have not materialized. Things are looking pretty well. Just look at GDP, look at the stock market. It's pretty robust. We made a couple more new highs here for the Dow in December. That's 20 this year. So it's one of those years where you're looking at somebody who's doesn't have to worry about what getting reelected. They're just doing everything that they can to keep the market and the economy moving along. You
sound very bullish, but you said there's going to be a lot of volatility in Q2 and Q3. What's the cause in your mind? Is there a historical precedent to have that volatility in Q2 and Q3? And then what leads us to the rally in Q4? Because you're also calling for that. So what's the problem? How do we fix it? And how do we go higher?
Well, I mean, you've got your usual seasonal weakness during the weak summer months, the Salome period, the worst months of the year, May through October, where people tend to do other things and get outside and get away from the market. And then you've also got the midterm elections themselves, which tend to take attention away from economics and the economy. And again, with this current administration, this current president, been known and shown himself to get involved in down ballot elections, and that's what can happen in the midterm year. So you see that weakness. The incumbent president's party tends to lose seats in the midterm year, so we've got a very thin margin in Congress. That becomes a fear. Markets do better under Republican Congresses. That's a whole other story. But and then Q4 rally. Yeah.
So you say August, October is the best window to buy stocks, right? But that's right before the midterms. You're also, I'm looking at your notes, you're not counting in a possible shutdown, tariffs being overturned. So does this trend stay the same? August, October is the best period if we see some pretty big macro things, government shutdown, the possibility of tariffs being overturned, or does that kind of break in your mind the historical precedents and the pattern that you're seeing?
Well, I mean, that's where the fear of what's going to be the outcome of the midterm elections start to happen. Markets an anticipating mechanism. It's going to go down ahead of the elections. And August, October is that weak seasonal period anyway. Didn't happen this year, which is a bullish sign in my view. So that sets up this Q4 rally. And the sweet spot of the 4-year cycle is Q4, the midterm year, to Q2, the pre-election year. Dow and S&P up 19 and 20%. NASDAQ up almost 30, 29.3%, I believe. From Q4 of midterm year through Q2 of the pre-election year, you get that 50% move possible. NASDAQ does from the midterm low to the pre-election year high about 66%. So it's just set up. I mean, Q4 is where all the rallies happen. We've seen that so far this year a bit. I mean, there's some profit taking. We've come off of a big AI tech.
Expect to wait in line for returns, which are again expected to peak for the year this week, according to Adobe. Sure, returns are annoying for consumers, but the rising cost of returns is a true pain point for retailers. Courtney Reagan joins us now with more. Hey, Court.
This is one of my favorite topics, reverse logistics. I know it sounds so sexy, right? But seriously, returns is really fascinating to me. That hot pink sweater, not really you, or maybe you don't really need more cheese knives from your in-laws, or maybe that's just me. But the NRF estimates almost 16% of total 2025 retail purchases will be returned. That's $850 billion worth, and it'll cost retail $75 billion. The cost to return an item can be anywhere between 20 and 65% of its original value. Why? Well, because a return triggers a decision tree of sorts. Software, and increasingly AI, determines the path to recoup the most value at the lowest cost, from restocking it in store, shipping it back to a fulfillment center, selling to a liquidator, or throwing it away. And as online shopping increases, so do returns. 22% of online purchased apparel is returned. That's almost 4 times the rate for in-store bought apparel. This at least according to an ICSC survey. Some estimates actually put that much higher. Because consumers are bracketing, or they're buying more than one size or color and rarely intending to keep more than one, but expecting free shipping each way. Blue Yonder manages supply chain and returns for 23 of the nation's top 25 retailers. CEO Duncan Angrove says few retailers have one person that owns returns, but those that do see a significant, return.
You're talking about double-digit improvements in gross margin. You're talking about improvements in sales. Like I said, I mean, if you're in apparel and 1/3 of your inventory is being returned, that's basically your largest supplier that you're not managing. You've got inventory coming back in, a lot of it, which, almost 1/3 of it doesn't go back on sale. It goes into a landfill.
Higher returns hurt margins, so retail return policies are getting tighter, even personalized. Returns management firm Loop says the number of brands charging for returns is up 6% year over year. That's the 4th straight year of increases. Some brands are shortening return windows, or maybe saying you actually can't get a refund, you actually have to do an exchange. AI is helping making those personalized person to person in some cases.
Hey guys, welcome back to my channel. I hope you all are doing well today. Let's start our video. Most people think the AI boom already happened. They are wrong. The real AI wealth cycle has not even started yet. We are still standing at the entrance of the largest technological expansion in the human history. And the next decade will be create a more trillion dollar companies than any period before it. Why this boom is different? Every past tech cycle was about software. This one is about physical infrastructure. AI is not an app. AI is an industrial revolution, which means the real winners will not be a social app. They will be a companies building the digital factories of the future. NVIDIA is no longer just a chip company. NVIDIA has quietly become the operating system of the reality itself. Factories, robots, logistics, defense, energy, and transportation. All of them are now being rebuilt on NVIDIA software stack. Once an industry is built on NVIDIA, switching becomes nearly impossible. This is not a competition. This is a structural control. The new AI control layers. 3 layers can now decide the global power, compute, memory, and electricity. However, control these three control AI. This is a new economic command center. Memory is the new oil. Without a high bandwidth memory, AI chips are useless. Memory production is booked years in advance. Only a handful of companies can supply it. This is quietly become the one of the most profitable industries on the earth. Power is becoming strategic. AI data centers now consume as much power as cities. Utilities, transformers, cooling systems, and the grid builders are now critical infrastructure. They are being booked out into the 2028 and beyond. Power is no longer boring. Power is now a weapon. Data centers land is the new digital gold. AI factories must be built near the high capacity substations. This makes a certain land location suddenly priceless. A new industrial real estate boom has begun. Robotics will control labor. Robots are becoming the new workforce. The company that control the robotic operating systems will control the global productivity. This is the next trillion-dollar software layer, the nuclear AI revolution. Renewables are not enough. AI needs stable, massive, and baseload power. This is why nuclear energy is returning. Small modular reactor will power AI cities, data centers, and manufacturing hubs. Nuclear become the backbone of AI dominance. Why the most people will miss this? Because it's look boring. Steel, concrete, cooling, transformers, grid lines, and warehouses. But this is where the real fortunes are built. The next decade, the next 10 years will be reshape the money, labor, and the nation. This is not a trend, this is a civilization reset. And the early infrastructure builder will control the future. Outro. This is why I remain extremely bullish on the AI super cycle. The real explosion is still ahead. Now we are only at the beginning. The real AI empire, infrastructure war. Most people still believe AI is about chatbots. They think this is a revolution is happening inside phones and laptops. But the truth is far bigger. AI is building an extremely new physical world. And whoever owns the infrastructure of the world will control the future economy. The AI infrastructure war has already begun. Right now, a silent war is happening. Not with missiles, but with the land, power stations, transformers, memory chips, and the water rights. This is a new arm race. Countries are fighting to lock down grid access, nuclear permit, chip fabrication capacity, high bandwidth memory supply, and cooling water sources. Because without this, AI growth stops. Why NVIDIA is the center of the storm? NVIDIA is not just selling the chips anymore; they are becoming the operational operating system of machines, robots, and factories. Every robot trained inside the Omniverse is a future NVIDIA customers. Every AI factory is built on CUDA is a permanently logged into NVIDIA. Once an economy is trained on your stack, it will never leave. This is how empires are built. Power is the biggest bottleneck. Compute is not the bottleneck. Electricity is. AI data centers are so power hungry that cities are running out of the capacity. Some AI clusters now draw more electricity than the entire country did in 10 years ago. This is why utilities, nuclears, and the grid builders are exploding. Without a new power plants, AI growth physically stops. The return of nuclear, solar, and the wind cannot power AI alone. AI needs stable 24 into 7 base load. Nuclear is the only solution that scales. Small modular reactor will become the engine of AI cities. This is not speculation. Permits are already being filed. Data centers real estate is the new gold rush. The most valuable land on the earth are no longer the beachfront. It is the land sitting next to substation and nuclear corridor. Developers are quietly locking up these areas for next 20 years. This is the next Manhattan land grab, but the digital. Memory control AI speed. Without high bandwidth memory, GPUs are useless. HBM factories are sold out years in advance. This creates a permanent pricing floor. Memories companies becoming toll booth on the AI economy. Robots replace labor within 5 to 10 years. Warehouses, factories, farms, and construction sites will run mostly on autonomous robots. The cost of labor will collapse, production will explode, and the companies controlling robotics operating system will dominate the world. The most important truth: this is not a bubble. Walls are demands are illusions. AI demand is real and structural. There are not enough chips, not enough power, and not enough memory, not enough data centers. We are still in the shortage mode, not access, which means the super cycle is still early age. Final message: the greatest fortune of the next decade will be not built on apps. They will build on power plants, land, memory factories, and the AI infrastructure. This is the real empire, and it is only just the beginning. And if you are watching this video till now, then please subscribe my channel or also share with your friends who are still holding NVIDIA.